thank you everybody so much for joining this month's April's Masterclass. We're going to be doing this one a little bit different, and probably for the next few and maybe indefinitely, we've decided to make a bit of a switch and make this more of a conversational webinar. So instead of focusing on the product or updates or things, we're going to try out a little bit more of a podcasting style here. So we're going to be bringing on guests from within the company and externally to talk about different things in the legal software sphere, which surprisingly, I'm finding is actually way more interesting than what I had thought. I had a conversation with Gary, our COO, who will be joining us next month. Brief conversation, and what I thought would be a brief conversation in the hall about his feelings on time entries turned into a pretty exciting 20-minute conversation. So I'm actually looking forward to talking about time entries of all things. But this month we are joined by Tracy Cook, who is one of our teammates here, and actually one of the teammates that's been with us the longest. She and I will be discussing trust accounting compliance, which seems like it might be a riveting conversation based on the back and forth we've had already, Tracy.
It's everybody's most favorite subject.
All right, so
I already know.
Yeah, no kidding. If you want to go ahead and just give everybody an introduction of who you are, your background, and what you do here at LeanLaw, that'd be great.
Sure. So I have been doing bookkeeping and accounting related stuff for, I hate saying this out loud, about 30 years. Started out, in my mid-20s, and within the first 4 or 5 years began working for a law firm. It was a general practice law firm with about 6 attorneys. They all did something different. And I fell in love with like the whole legal profession thing. And from there, I went on to work for a number of other law firms over the course of time, moving from Massachusetts to Nashville. I was firm administrator and controller at one, accountant at the others. And it's been fun. It's been a lot of fun. So I've definitely cut my teeth on legal accounting and trust accounts, including back in the days before there was any cool software to help make it all easy. So yeah, it's been fun. With LeanLaw, I do all of the onboarding for new clients and training and help the support team answer tricky trust accounting questions.
So fun fact for those who may not know, Tracy was, you were the second hire to the support team originally, but you revealed to us pretty quickly that at the time we were doing trust accounting completely wrong. And that was a bit of an unintentional pickup there, realizing oh, okay, so maybe we shouldn't make separate bank accounts for every trust account. It's pretty crazy how far we've come when we look back. And you've been with us for 5 years?
No, everybody wants to say 5 years. It's been 3.5. Feels like
it's definitely been longer.
Yeah.
I can't believe we made it that far without you. So it's definitely been great working with you, and I'm glad you're part of the team. So back to trust accounting and compliance of trust accounting, real quick, high level, what is trust accounting?
Basically just keeping track of those funds that you're holding on behalf of a client, for whether it's for a retainer for future, to be put against future legal services, or if it's escrow situations for real estate type deals. It's keeping track of the money that you're holding for them.
And why would a law firm want to do that? I mean, that's a lot of work to just keep, a couple $1,000s for a client in a bank account.
Well, it is, but most firms see an advantage of requiring retainers up front. Basically, it kind of helps the client be committed to using that attorney. It ensures that the attorney can do some work and know that they'll at least get that much money paid into what they've done. So it just helps establish that relationship between the attorney and the client. Yeah,
I mean, not having to worry about getting paid at the end is, I'm sure, is a huge relief. I mean, I don't have to worry about Jonathan cutting me a check. I can imagine for an attorney that getting to that level of security is.
Yeah. It just kind of puts a little skin in the game on both parts.
Right. Yeah. If I'm going to be doing work for you, it'd be nice to know that I'm actually going to get paid at the end of this, and that you actually care about the work that's being done.
Exactly.
So how does trust accounting actually work?
So this is a few different parts to it. One, it requires the firm to have a separate account for all of the trust money, meaning that they cannot add it into the same account that they use to pay their bills, which is usually their general operating account. So there's a separate account set up for just that purpose of holding everybody's money, because that money does not belong to the law firm. It belongs to the clients. Second, just about every state now requires that you have a liability account on your chart of accounts also set up. And that's because, I'm going to not get into the weeds, but bank accounts are listed as assets on the balance sheet, and usually something that you own. So even though that trust money is in a bank account, you don't own it. So everybody is required to have a liability account also on their balance sheet to offset that, to show, okay, I've got the money separate, but I also know it's not mine, so that I have a liability against that money because it doesn't belong to me. And then it's required that every client that has money in trust have a client trust ledger, which is set up as a sub liability under that liability account. And just that everything's recorded, all of the money in, all of the money out, where it came from, what it's for, who it went to, dates, amounts, lots of details.
So does it work to just have a spreadsheet instead of something set up in your accounting software?
Well, I've seen them. I mean, it can work. It's very messy. It's kind of leaves you open to lots of mistakes. So
Gotcha.
it's definitely not the best way to do it, but it's better than a shoebox full of receipts.
How about a whiteboard full of T tables and a spreadsheet?
You know, hey, if the state bar comes and knocks on your door and wants to do an audit, if you have your laser pointer and can guide them around and make it make sense for them, I guess it would work. But there's definitely much easier ways to do that, for sure.
So why is, you mentioned jokingly, the bar coming in and wanting an audit with the laser pointer on the whiteboards. Why would a firm want to pay attention to that or the potential of that and be in compliant with what the state requires?
Yeah. So, and it's not even just the state. So there's all kinds of rules that kind of come into play with trust accounting. So you've got usually the American Bar Association sets some big rules. State bars set individual rules. Even the IRS has rules. So there's lots of rules that have to be followed. Most of them are what I just talked about before about, having a separate account and individual ledgers and things like that. But there's some specifics. But the problem is if you don't follow the rules and, either somebody reports you or it's just a random audit, which all state bars are allowed to do. You want to make sure you've got all of your, T's crossed and I's dotted, because you can get in trouble. There's a number of things that can happen.
Like what happens if you're found to be not compliant?
Well, there's disciplinary action. So the firm can get fined. They can lose their license and get disbarred if there was like a really, extremely egregious issue that happened, such as, embezzlement or something like that. But
you mean like lawyers could lose their ability to practice law if the accounting doesn't check out for trust?
Yeah. Yep.
That's not terrifying at all.
Right?
That would make me really hesitant as an attorney to start trust accounting, because
I know some attorneys. Yeah, I know some attorneys who absolutely don't have trust accounts just for that reason, because it's terrifying. But it's also really simple to kind of keep everything the way it needs to be. So it's not a big thing.
Okay, simple for an accountant.
Well, yeah, that's true. I mean, I had a firm that had reached out that was going through an audit, and is just a simple math error, and they just happened to be there for a random audit and things didn't line up, and he didn't get disbarred or anything. He didn't even get fined, but there was like tons of hoops to jump through. I wrote a letter. I outlined, like a written procedure manual on how everything's going to be going forward for him. Get all kinds of stuff. And so they, he was being basically monitored for a year after that to make sure everything was good, which it was, because then he started using LeanLaw, but that sounds like a commercial. So I'm not going to slide that in. But anyway, but yeah, there's definitely some repercussions that can happen if people don't pay attention. Your reputation can get damaged. lawyers talk and things get published in different journals and so forth. And, they're all at the gym and someone's saying, hey, did you hear about so-and-so? And, you just don't want to, you want to try to avoid all of that headache if possible.
That's right. You don't want to end up in the tabloid magazine for attorneys on, getting
Exactly.
disbarred for forgetting how trust accounting works. That doesn't look good for anybody.
No, definitely a bummer.
Is there anything that, like, could the clients be harmed by any of this, like mismanagement of trust accounting or, not being compliant with bar requirements?
Yeah, absolutely. If firms don't keep good records and don't know what's going on and, understate what a client actually still has in their trust account. The client, believe it or not, some clients don't actually pay very good attention either. And, they could basically end up paying more money for things than they needed to if they had trust funds that weren't accounted for properly and didn't get applied correctly. If there's, in the case like of a personal injury thing I'm thinking of, if things were accounted for wrong, maybe the client didn't receive all of the settlement funds that they should have, if things weren't correctly. And there's definitely ways that clients could be harmed. And then that, if a client even thinks that something got messed up, that also runs the risk of the client then calling the bar association and making going to prompt an audit. So, you want to be nice to the clients and make sure that they're comfortable and know what's going on too. And there's ways to be able to do all of that.
Right. And I would imagine, like other service oriented sectors, if you have a bad experience with one attorney or one law firm, that's going to change your opinion of, broadly speaking, lawyers. I mean, that's why you get the sentiment, lawyers are jerks, people not being fans of lawyers. There's a bar here in Boise for years called No Lawyers Allowed bar. And I would imagine that's not in large part, but partially because of people's bad experiences and potentially mismanagement of trust funds.
Yeah, that definitely can lead into it. I mean, it's easier just to pay attention and do things the right way than to kind of run the risk of, causing all kinds of problems for everybody.
Right. So in your experience, what have been some of the most common mishaps or, not being compliant with trust accounting, whether lack of, not paying attention, not having accounting people on staff actually paying attention to it? Like what have you come across in your many years of experience?
So the biggest thing is just not paying good attention or not having the right qualifications to be, or the right training even. I mean, you don't have to be an accountant. I mean, you can be an attorney who just has learned how to do it the right way. And that's fine. That'll work. But the biggest thing is mistakes, like the attorney that had reached out to me that I talked about earlier. That's just errors.
Mm-hmm.
The next biggest thing, which happens and people don't even know it happens, is kind of like the failure to know your particular state bar requirements, because they're all different. I was looking at some the other day, and just they vary. I mean, they all have the same major components about how to record things, what to record, what to keep track of. But there's Wisconsin had a thing in there that doesn't allow telephone transfers, but it allows wires. North Carolina requires you actually to have like a written statement saying that you reviewed things, your monthly review or your quarterly reviews, and keep that on file so many years. I mean, there's all kinds of different little nuances that happen, within each state bar. And so it's just really important that people, try not to terrify themselves and kind of read through it. But it is, it's definitely good to know, because I just always think about that, one client that's going to go on and read all those rules and say, hey, they didn't do that for me, right? Yeah. And that's going to be the one that causes you trouble. So if you just kind of can stay ahead of that, that's a big thing. Some states require monthly three-way reconciliations. Some require quarterly. Some require them to be, printed and signed. Some require that you just have them somewhere on your hard drive. So that kind of thing is big. Another big issue is if you let your trust account become overdrawn, and a lot of people don't know this, but
Oh,
banks,
because it's all one shared bank account, and the bank doesn't keep track of whose money, but like which, of the $1 million in the trust account, the bank doesn't keep track of this is this client A's money and this is client B's money. That's why you have the ledger, right?
right, but if that account, and the trust account should never be overdrawn because you should never take more out than what's in there.
Mm-hmm.
That would go back to making mathematical mistakes and things like that. But in most states, banks are required to report to the Bar Association if a trust account becomes overdrawn. There you go, prompts another audit. So
Yep.
those kind of things. Of course, the big one, which I've never actually seen, is commingling, where you're mixing all your money together in just one big happy bank account, paying your electric bill, paying the client trust money. That's the biggest thing, the biggest bad thing to do. But I've never seen that actually happen in real life.
So we're not allowed to let the food on the plate touch. You can't just like take the spoon and mix it all up. It has to be separated nicely into each little segment.
Yep. Keep the peas away from the mashed potatoes. Definitely.
But that's the best part.
I know.
And how does that happen? I mean, how do you said at the beginning, you're supposed to have a separate checking or operating account, a separate bank account for like, how do you end up crossing those wires if they're totally separate bank accounts?
I mean, I have no idea how that would even happen, honestly. I mean, I think probably what would happen more than likely than the fact of somebody just having one bank account, with somebody saying, oh, well, I should be earning some money from, Joe Smith next week, and he's got this money in trust. So I'm just going to pay my electric bill out of the trust account. That would be hugely frowned upon.
Right.
So, and I do know of a recent story where I found somebody like paying some bills out of the trust account because they knew that some of that money was actually earned, but I'm like, no, you got to create your invoice, pay it out of trust, move it to your operating account, and then pay your bills. Yeah. So I had a little mini heart attack for a minute, but we got that straightened out. So that would also be considered commingling a little bit, but not in the actual sense of the word.
Right. So Becky in chat actually had a point that bank charges should not be taken out of the trust account.
No. And most states will know if it's a trust or an IOLTA account. Most states will accommodate that by charging, if there are any bank fees, to charge them separately out of the operating account. If your bank doesn't do it, I would check with them. If there's absolutely no way that they won't accommodate that, I would do one of two things. I would either like look for a bank that does, or you would set up basically a firm matter, just called firm trust, to leave a buffer in there to kind of absorb those fees. But you would still actually even keep a ledger for that, even though it's not a client, just to keep everything in balance.
Right. Yeah. Still trying to keep everything separate because the bank isn't doing automatically. And we've had a couple of firms that we've worked with that did get in trouble for failing to maintain records for a variety of reasons, largely because the person they had on staff to do the accounting was horribly ill-equipped to do so, and resulted in actually the Canadian Bar Association, the CBA or the ABC, getting involved in contacting us directly as the software provider and saying, hey, we need these records because XYZ firm has done such a horrible job managing. We're now opening an investigation and getting involved, which that is the last thing you want as a firm. And I wasn't even the firm, and I was like, oh my gosh, they did what now? And now I am being held accountable for this? Nope. Nope.
Yep. Yeah, that was crazy. But luckily or unluckily, like LeanLaw actually had nothing to provide because their trust records in LeanLaw weren't. So,
right. They're all housed in QuickBooks. Yeah. So I just directed them to the QuickBooks support team and said, here's the information. Like, best of luck. I hope you find what you're looking for.
Yeah. Yep.
So we've talked about what can happen, what are some common issues, what's required to make trust accounting happen. And it can be a daunting process for a firm that's never done it before, or someone who's not super familiar with the ins and outs of trust accounting or the ins and outs of legal specific accounting. What are some potential tips or easy maintenance items that you could provide for the audience on maintaining compliance with trust accounting?
So first, and probably the 10th time I said it, go to your state bar website and just make sure that you're familiar with what your state requires. And then actually make some written policies. So whether it's, you or other teammates in your firm, or, if you leave, there's something, for somebody else to follow behind you and know like what the actual policies are, so that everything's done consistently,
Mm-hmm.
and, the same way all the time, to what you have to do for record keeping purposes.
Right.
The other big thing is your engagement letters that you do with your clients. Some of the state bars require certain language in your engagement letters pertaining to how you're going to use client trust money. So if you have it in your engagement letter that when you create an invoice for fees that have been earned, you're allowed to, pay yourself out of their trust account, out of that retainer, which is what the retainer is for usually, to pay that and then move that money from trust to your account. Some states and some firms recently that I've come across have like a 7-day wait. So they'll actually send the invoice to the client and they have a specified amount of time. And one of them, I know for sure it's because that's how they have it in their engagement letter, which they're about to change.
Mm-hmm.
The client has a defined period of time in which to, dispute the charges before the firm can take it out. So just make sure you've kind of got that down on how you're going to handle all of that, and just have an established policy for that.
Right.
Big thing, reconcile your accounts. Pretty much everybody requires a 3-way reconciliation. There's lots of not disagreements, but lots of different ways that people think it needs to be done. It's a very simple process. It's all done on the QuickBooks side. Obviously everybody's here using LeanLaw, but when you do your online bank reconciliation, print your reconciliation report, print your trial balance, your statement, your register balance is going to equal the bank account asset, which is going to equal your liability, which is going to equal all the sub liabilities underneath it.
Yep.
And stick it in a Google Drive and you're good. That bank rec covers a lot of the steps that most of the states require as far as showing anything in transit, uncleared, cleared, and that bank rec report in QuickBooks will have all that info for you. And just print them out that same day as of that end of that month, tuck them away and hope you never need them. But if you do, you got it. Big thing, make sure you have someone that understands how to do it and is capable of, doing those bookkeeping tasks. And of course, LeanLaw is awesome in kind of helping keeping all of that trust stuff in line. I've used lots of different softwares over the years and done it manually, and LeanLaw's like pretty exciting as far as making it simple to keep everything where it needs to be. I think last thing for attorneys, if you get any CLE opportunities that, talk about trust accounting, especially because it'll be bar specific for your state, go to it and just share that information when you get back with whoever's doing your trust accounting.
Yeah, like you'd mentioned earlier about checking the state bar requirements, just like doing that on an annual basis, biannual, and making sure like, are we still in compliance? Yes. Okay. Easy check marker. Do we need to change something slightly and make sure the accountant knows? And I mean, do they need to have someone full-time doing the bookkeeping and accounting for trust, or is that something that you could have someone come in on, say, a monthly basis? And it sounds like so long as you have the process set and communicated with everyone, this is how we do trust accounting, these are the expectations, this is, the buttons you click. Assuming everything goes well, you just need someone to come in at the end of the month and go check.
Yeah, and it's going to be, whoever's reconciling bank statements at the end of the month can print out the trial balance and kind of have all that together. And as long as everybody during the course of that month, anybody who's recording deposits to trust or writing checks out of trust, as long as they're doing it the right way, everything at the end should line up, and it's not even a it's like a non-issue. It's just
So
printing up the reports.
if you can set it up correctly, maintain it consistently, stay abreast of changes, any potential changes to bar requirements. Obviously, three-way reconciliation is part of that. Then, I mean, there's very little work that seems like you have to do. It's just the setup and a little bit of maintenance. And having a software that does a lot of that for you sounds really nice. But I mean, you still have to have those inputs and those checks on the other side.
Right. And don't mix your peas with your mashed potatoes.
That's you know, when you put it that way, trust accounting seems a lot easier.
Yep.
Cool.
We have a couple of questions.
Yeah, let's go through some of those.
All right.
We've got one from Jack. It looks like Jack had some Ontario specific questions. So Jack, if you want to pop those into the chat when you get a second, we'll do our best to answer those. I am certainly not well versed in Canadian or Ontario specific, but I do know we have some Canadian firms here, so I might have an idea. Patrick asked, how does LeanLaw help an attorney keep trust accounts in line?
So I'll answer that. So with LeanLaw, when you record a deposit to trust, you record that in LeanLaw. And as you make that trust deposit transaction, it asks you for the client. If it's the first time you're setting up a trust account for a client, it'll tell you that QuickBooks will automatically do that for you. And you fill in the amount, who it's from, what it's for, and you save it. So right by that one thing that you just did, you created a deposit into your trust account check register, and you created that entry into the client's trust ledger for the liability side. So everything went in even. So those the bank account, the liability, and the client liability all went up simultaneously, staying nice in order. When you write a check out of QuickBooks, out of a trust account, it refers back to that liability account. And so everything goes down altogether. So you've got coming out of the trust account and then out of the liability account, out of the client ledger altogether. So LeanLaw definitely helps by minimizing the steps that you need to put all of those transactions in all the places that it needs to go. Just, it makes it simple. For sure.
That does sound a lot easier.
Mm-hmm.
Emery with an interesting one. I'd be curious to see if you can answer this one, Tracy. Is there a max length of time a firm can keep money in trust after it's earned? I'm thinking maybe someone could theoretically get positive tax consequences by managing when they realize the income.
Well, if they're not taking it out of trust, they're not able to use it. So I'm not sure how that would be a positive tax. I mean, I see what you're saying. Yeah, so I don't know that there's a time that you have to take it. I do know of some firms, especially contingency firms, who, if they have a settlement towards the end of December, won't take it until January. I don't think that's any type of illegal issue. That's just a money management thing. But that did remind me of something else I wanted to say. Most states have also a time limit. So if you have a client that died, or you've just messed up your trust account really bad, and now you've got extra money in there, and you've accounted for everybody that really does have money in there, but for some reason there's extra money in your actual bank account, can you just move that to your operating account and just to make everything even? The answer is no, you cannot.
Why not?
Because you don't really know where it came from. Chances are you screwed up and it's your money anyway, but it's unfortunate for you that if that's the case, you can't just create an invoice and move the money. You can't just move the money. People do it all the time, but technically you're supposed to leave it in there. It varies in the amount of years. Some states have 3 years, some states have 7 years. And then at the end of that time, if you've done due diligence and, reached out to anybody and everybody whose money it could possibly be, and it still doesn't belong to anybody, you still don't get it. You have to send it into the state.
So using trust accounts as a secret lockbox for funds is not a good idea
No.
because the state's still going to take it at the end.
Yeah.
So Kelsey asked, is there a clear report I can generate in LeanLaw that tells me what accounts need to replenish their evergreen?
Nope.
Yep, that's one for Gabe and the product team, Kelsey.
Sorry, Kelsey.
So Jack did get back to us with a bunch of the specific reports that he's looking for. Tracy, I don't know if you're already familiar with those, but we might need to take that offline and contact Jack afterwards with the specifics on that.
Okay.
Looks like we've
I'm
got
trying-
valuable property records, referral fee records, client trust ledger, Form 9A. I am not the accountant, so all of this looks like alphabet soup to me.
Let me look at what's that. Yeah, we don't do 9A. Let's take this offline with Jack because that's some specific Law Society stuff. I saw something in client ledger's balance bank as well. So that was from BH. Who's BH? Oh, Becky. So yeah, Becky, when at the end of the month, when you do that three-way reconciliation, when you pull the balance sheet, it's going to list each client's sub-liability under the liability section. So all of those are the client ledgers. So they're all going to total the top level liability as well as the amount in the bank account. So there's that.
Gotcha.
What else do we have?
Do you have a recommendation on holding settlement funds for a client? We're currently holding in their trust, but it's mixed with their actual retainer. Should I create another trust account for that client?
That's entirely up to you. Some firms, I can think of one off the top of my head that they have two separate trust accounts. They've got one for retainers and one for escrow amounts. Just because it's easier to track, if you've got, $5 million in the escrow account, it just makes it easier to track all the escrow money than, somebody that's got 1,200 left in a retainer. So there's not like a hard, fast rule to it. I think it's more of just a firm preference. I personally would have two separate ones, one for the retainers and one for the escrow.